Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Sui Chung, CEO of CF Benchmarks. We're going to take a look at inflation and interest rates and the impact on the crypto space. Sui, it is great to see you again. Welcome back to Trade Talks.
Fantastic to see you, Jill. Hope you're well.
We are doing well. And it's been a while since we caught up last. What's going on? What's new at CF Benchmarks?
Well, here at CFB, we've continued to be very busy supporting our many licensees, including the CME, who are launching micro Bitcoin options and micro Ether options at the end of the month. So a very exciting development for traders looking to hedge, increase, decrease their exposure to the major cryptos.
And what about interest rates and inflation? I mean, there's been a number of headlines that the market is contending with, and certainly Bitcoin, Ethereum, the rest of the crypto space has not been immune to them. What are your thoughts on the market overall?
Well, obviously, the tragic events that are underway in Ukraine could have a pretty significant impact on all the interest rate expectations that we all have. Earlier this year, we were looking at potentially 6 rate rises from the Fed, multiple rate rises from the ECB and the Bank of England. But the events in the Ukraine and their knock-on effects onto energy prices and inflation and the markets and all asset markets, which have obviously taken a serious jolt from these events. The question now is whether the major central banks will push through with such aggressive tightening of monetary policy, given the liquidity support that the markets need in times of acute geopolitical stress that we're going through. And the knock-on effect is that potentially this is good news for particularly Bitcoin as the inflation hedge trade for Bitcoin and indeed gold gathers momentum.
Right. It's so interesting, Sui, when we think about the overall health of the crypto space, it's interesting to see how it is trading somewhat in lockstep with the equity market, outside of the narrative that Bitcoin might see more inflows just because it'll be a way to transact currency. But initially, it wasn't like that, where it wasn't as correlated to the equity space as we see now. What are your thoughts on that?
Obviously, correlations have been on the increase. They've risen pretty significantly, and you're right in that certainly in the past 3 or 4 months, the correlation with equity markets has been very high. I think that we will continue to see that for a short period as liquidity conditions are adjusted to by investors. But once we get through this initial sort of shock, if you like, of liquidity conditions changing, then I think we'll see the cryptocurrency markets, digital asset markets begin to break up that correlation as rates rise, although possibly not as aggressively as once thought. Rates rise, fixed income comes back into play, and equities become more associated with their long-term growth potential as opposed to their yield, obviously, which because in the low yield era, equities, high yielding equities have been a substitute for bonds in many portfolios. I think we'll see that bifurcate, and then we'll see, I think the digital asset class will again trade on its own merits.
All right, so we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thanks for your time, Jill.